Welcome to the Market Observations Call for August 22nd, 2022. I'm your host, Eric Jefferson. We'll start today by recapping last week, where we saw the month-long winning streak in the S&P finally come to an end. The index traded lower just about a percentage point. We'll talk about the two key drivers there in just a moment, but want to take a step back and just revisit broader performance. If you go back to mid-June, we saw the S&P rally over 15% through the end of the week prior. Despite that rally, we're still about 12-13% lower and current trading than where we were at the beginning of the year. And obviously, a lot of that volatility is a function of high inflation and the situation in Ukraine. Certainly, growth around the world is slowing, and that impacts risk assets. But one thing to keep in mind, the U.S. market has actually held up much better than the rest of the world. If we look at the developed international, primarily Europe, their market is down probably about 1.5 times us. They struggle with inflation, arguably more so than we do. Also, their economy isn't necessarily as strong, so not as able to withstand some of the medicine that you need to take in order to curb inflation. Certainly, too, more directly impacted by the situation in Ukraine. If you look to more of the emerging markets, those are the faster growing countries and regions of the world. Their growth and underlying stock performance tends to be more correlated with global growth. So again, where they have that cyclical nature and we've seen growth slow, that is typically felt more in those regions. So despite all of the negative headlines, despite all the volatility, worth just reiterating, our markets have held up reasonably well, again, relative to the rest of the world. As we specifically hone in on last week, two key drivers of market performance. First, we got some mixed results from US retail stores. Those are the Walmarts, the Targets of the world. And markets really use them and their results as a way to gauge the health of the overall consumer. Again, the consumer accounts for about 70% of our economy. And when you have high prices like we do with historic inflation today, at times that will be a negative headwind, or that will decrease how much a consumer is willing or even able to go out and spend. And so we have this tradition where once a quarter we hear from corporate execs. They talk about how their companies did. They offer some guidance on their outlooks going forward. We'll certainly touch on any key themes or trends that they've seen within their industries. And markets were really looking for some direction on where we go from here. Interestingly enough, when we look at the economic data, consumer spending in the face of high prices has actually held in reasonably well. That's encouraging. But again, the question is always, where do we go from here? With some somewhat mixed and cautious results coming out of those retailers, markets took a little bit of a pause, again, not being so confident necessarily that the strength of the consumer will continue. The second and arguably more impactful event last week were the Federal Reserve, or FOMC, July meeting minutes. Those are closed-door sessions, but they will publish a transcript of everything that was discussed. And within that report, we got some very mixed messages around inflation and their path of interest rates. Again, with historic runaway inflation, one of the ways that the Federal Reserve will combat that is by raising interest rates. The challenge, though, if you raise too quickly or too far, that can stunt growth and send your economy into a recession. And so as analysts went through and dissected the meeting minutes, we had some in the camp. You saw quotes of, there's very little evidence to suggest that inflationary pressures have eased. They, as you would expect, reiterated their emphasis or their commitment to get inflation back down from 8% to the long-term average of 2%. And when we think about the landscape today, certainly last month, headline inflation came down marginally. A lot of that was a function of lower gasoline prices. If we strip that out and we just look at the core or the stickier components of inflation, that remained relatively flat. Obviously, for things to get better, they have to stop getting worse first, but still hard to argue. There was concrete evidence that inflation has finally peaked and trending in the right direction. Obviously, there are those in the Federal Reserve that are looking for that confirmation before they make a pivot. Then again, on the other hand, we did see many reference or suggest that the pace of rate hiking may start to slow, potentially even as early as the September meeting. Recall the last few rate hikes have been in the 75 basis point camp, which is a historically high. That is a very large number relative to typically what they are. Certainly, that speaks to how serious the Federal Reserve is taking inflation. But again, very difficult to get a read on where we go from here. I think whatever your bias of what inflation and interest rates will look like, whatever your bias was going into that meeting, you probably saw something that confirmed those views, which from where I sit makes it really difficult to have a high conviction in one way or the other. I don't even know that the Fed knows what they will do, as they've continued time and time again to reiterate their actions will be a function of what the data suggests. They are data dependent, not on a preset course when we think about raising interest rates to combat the current historic inflation that is obviously holding back our economy. We will actually learn a little bit more about that this week. This is the Jackson Hole Symposium. We're going to have all of the Federal Reserve governors out in Wyoming. We'll hear from Chairman Powell, 10 o'clock Eastern on Friday. Again, expect that message to, one, reinforce their commitment to get inflation down. Two, also suggest that we are not on a preset course, that it will be data dependent. And again, all of that goes back to the fact we simply just don't know where inflation is going to go from here and what that resulting Fed policy will be. Turning to other economic data, on Thursday, we will get a revised Q2 GDP reading. GDP, gross domestic product, that is a measure of how large our economy is. If you recall, in Q1 and Q2 of this year, we had a modestly negative print. Under the old definition of a recession, 2 consecutive negative GDP prints. That put us in a recession. Technically speaking, we are going to get revised figures for Q2. Expectations are actually revised higher, so more favorable. Arguably, that's a good thing. Also, we do have a number of forecasting tools that are primarily led by the Atlanta Federal Reserve. Those suggest we're actually shaping up okay for Q3. Now we may actually have a positive north of 1% growth on the quarter. Obviously, that is just a forecast. Impossible to know exactly what that will be until we get here. But when you think about all the doom and gloom in the news, keep in mind there are some positive, some somewhat encouraging data points out there as well. That's all for this week. As always, please reach out to myself if there's anything you'd like to discuss in more detail. If we don't chat, have a great week. As well, please ask you to stay tuned for a few disclosures from our compliance department. First and foremost, all opinions voiced in this video are for general information only, not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is certainly no guarantee of future results. Lastly, all indices are unmanaged and may not be invested into directly. All investing includes risks, including fluctuating prices and loss of principal. Thanks again for the time. Have a great week.